You're listening to the Practical Wealth Show with Curtis May, putting you in the driver's seat to control your finances. Let's start the Practical Wealth Talk about alternatives to Wall Street.
All right. Hello. Welcome to the Practical Wealth Show. This is Curtis May, your Money for Life guide and prosperity economic advisor. Okay, here to introduce you to the wonderful world of the prosperity economics movement. Listen, I am going to record a quick podcast because our assistant said I was just in a parking lot yelling in a good way. I kept to tell the clients, I'm sorry you got me all worked up here. And so forgive me for yelling at you, but I've been getting this a lot and it's like a serious pet peeve of mine. So what we're going to talk about today is, should you pay extra on your mortgage? Okay, because that, so give you a background. I, in the mid 2000s, actually added mortgages to my business and I discovered them, and I actually became a mortgage certified, what's it called, liability advisor. But basically, I did mortgages like an advisor. So I didn't care about rate and term. The whole idea was, how can you manage this asset called the house and the equity? See, because you have two sides, you got to think about your brain. You've got a left side of your brain, you got a right side of your brain. Well, on your balance sheet, you've got a asset side and your liability side. So for most people, the majority of their money is running through the liability side of their balance sheet, through their mortgage, through the house, and are really not getting any good advice in how to manage that equity. What I'm going to do is, I used to do a workshop. I'm going to update the numbers, but in the show notes, I'm going to link to a talk I used to give called How to Harness the Power of Your Mortgage. Okay, because how you manage equity is really important into helping you achieve your long and short-term goals. All right. And because one of the things that we talk about at Practical Wealth with our clients is that, most people give most of your money away. We call these transfers. So there's more opportunity in helping helping our clients minimize the losses in your life than there will ever be trying to pick winning investments. Okay. And so I'm going to give you a quick case study of a conversation I had this morning that, I'm trying to calm down so I don't yell into the microphone, but I'm still a little hype about it right now. But because the top 5 transfers are, right, how you pay your mortgage. Okay. The way you do that is so impactful in your life. Taxes. I'm going to do a separate episode on this also. Just getting tax refunds, how big a wave transfer that is, filling out your W-4 properly. Number 3 is how you fund your qualified plans. Kim and I went over that a couple of weeks ago, going over the 7 principles of prosperity, running the 401k through that. So if you're funding over the match, I'm not even going to sugarcoat, it's a complete waste of money. How you pay for college. My kids are in that age, so I'm really paying attention to that. So we're going to do some episodes on that. And also how you pay for big ticket items, which goes back to us showing you how to use permanent insurance to create your own privatized banking system so you can recapture the money that you're giving away. But let's talk about mortgages. Should you pay extra on your money on your mortgage? No. Right? Can I say it any clearer than that? So here's the thing. So I'm working with a person who's going to remain nameless. Hopefully, I think she might listen. She don't listen to it yet, but I'm going to send her the episode. And I've had variations of this conversation. So we're looking at, I'm saying, well, are you saving? Yeah, I want you to save. Can you save a couple $100 a month? Well, I need to. I don't really have a lot of money to save. So now I'm in the conversation. So this is kind of you may have heard of this. This person's West African. So there is a tradition in the Caribbean, and actually a lot of other people do it. So it's not just an African thing, but the Africans call it a susu. And they're wonderful as a way to force savings, and it's a good thing. But I think she was overly aggressive, honestly. So what happens is I said, well, I'm doing $200 a week in this susu. I'm like, what? I thought she said a month. $200 a month. Okay, I'm fine with that. $200 a week, that's $800 a month. I said, how much do you have in savings? Nothing. Okay. So now Now, when you get this money, I'm not sure how I forgot to ask her how long it rolls around, but $6, $8, $10,000. What do you do with it? I send it to pay off the mortgage, and I lost it. I was like, you do what? Okay. And so folks, there are levels to this stuff. All right. So now you're seeing it to pay off the mortgage. So let me start with this premise. What's good for the bank is bad for you. All right. So paying down your mortgage, that's good for the bank. All you're doing is strengthening their position. Equity is good for the bank. Once you understand how money works, so let's take two basic premises. One, because of inflation. Well, this first one, what we call defining moments. One, because of inflation, your money will never be worth more than it is today. Okay. So now, because of inflation, so now what happens is, don't you think banks know that rule? So why in God's name would you give your money, your hard earned money, to the bank? Okay. And because think about this. So, how does, so I asked her, I said, well, listen, when you pay extra money to the bank, does that make you money? Right? Because if you think of your balance sheet, right? So you've got assets. What's the asset? Something that puts money in your pocket, and you got liabilities, something that takes money out of your pocket. So your mortgage is a liability on your house, right? And the debt. And so, but on the bank's balance sheet, that $100,000 or $50,000 or $200,000 liability for you is the bank's asset. Your mortgage expense, that mortgage payment is their income. All right. So when you are sending $5,000, $10,000, doing bi-weekly payment, all that stuff, you're doing is you're foregoing your asset column to send your money directly to the bank so that you can get rid of debt. So let me ask you this. Is your debt right now, the way the tax law is, as I record this in 2017, if your mortgage is under, I think, $1.1 million, you can deduct that debt, right? So right now, Uncle Sam is your partner. And so why do you want to kill your partner off too early? So every time you do bi-weeklies, you send extra principal payments in, you make more payment, each payment, I'm sorry, more expensive because you're killing the interest associated with that, which you deduct, I believe, off the Schedule A of your return. Okay, the mortgage interest. Now, I asked her, I said, well, listen, when you make that big payment, does your payment change? Does it get lower? No, she's got a 30-year fix. So let me get this. You get $10,000, you give it to the bank. Now you have no savings, but you just took all of your money and gave it to the bank. Okay. So now you've got all this equity, but see, what if you lose your job? You can't access that equity. What if you have a Sandy or a Katrina or some type of disaster and something happens to that? All that equity is gone. Okay, you lose control. You're out of control. Here's another thing. What's the rate of return on the equity in your house? Zero. Okay, so the house is going to appreciate. So I ask people that question: what's the rate of return on the equity? They go, I don't know. The house appreciates it. Real estate goes up. The house is going to go up whether if you pay cash for it or finance it 100%. I mean, not 100, or finance it 100%. So if you had a $100,000 house, you paid $100,000 cash, and it appreciated by 3%. That next year is worth 103, right? So you got $103,000 worth of equity, but if you financed it at 100%, it would still grow by 3. All right. And and so now you've got leverage, positive leverage. And so what you've got to be able to do is you got to be smart. So if you could use leverage, why would you do that? Okay. Because I would argue she's put herself in a more precarious situation by trying to get rid of the mortgage too early. So I'm going to kind of give you a thought process. So here's how people used to think. And this is from a talk I used to give called Harness the Power of Your Mortgage. See, the old way of thinking, most people are taught to get the lowest rate you can to start a bi-weekly mortgage program or send extra. I used to do this for people. Like when I first started my career, I had this thing. I would show people how to do bi-weeklies, and I thought I was smart, and I would get amortization schedules and show them how, with this part is interest, this part is principal. If you send in these principal payments, this is how many years you knock off your mortgage. So what? You ain't going to be in the house but 6-7 years. Why are you trying to pay the mortgage off? Okay. And so what happens is this. See, and they'll send money to the principal balance wherever they can. That's the old way of thinking, right? So you can do what? Pay the house off as soon as possible. But this is a Depression era mindset that has been burned into the American psyche. And see, think about this. Is it possible, hear me now, that this is exactly what you should not be doing? Okay. And so there is one of the things I like. I mean, it's about typical advisor, but Rick Elderman, I first really got my mind around this from his book, The New Rules of Money. And the New Rules of Money says, look, you should get a big 30-year mortgage and never pay it off. And so he had all these mass affluent people that one of the things he knows is that nobody ever paid off their mortgage. Because see, folks, the rules have changed. See, now you want to choose the best mortgage, not necessarily the one with the lowest rate. You definitely want to stay away from bi-weekly mortgages. Never send extra money to your mortgage company, ever. Okay. Paying off your loan is like putting money underneath your mattress. So your goal is to make the smallest payment you can with the biggest tax break possible. So that means never paying off your mortgage. If they gave me a 50-year mortgage, I would take it. All right. Because you're going to pay to live somewhere. Let's talk about the truth about money. So here are 5 great reasons. And this is from Rick's book, The Truth About Money. 5 great reasons to carry a big, long mortgage and never pay it off. Reason number 1, mortgages don't lower home value. So your house will grow in value whether or not you have a mortgage. In fact, most will discover over time the mortgage balance falls while their home prices rises, creating substantial wealth that they never expected. Okay. And see, for your real estate investor, you definitely don't want to put money in the house. Okay. You're just pay your mortgage. Your tenant is paying the mortgage down. If you got extra, then you save that. We teach people how to do that in their private reserve plan, but that's another talk. So here's the second reason why you want to carry a big long mortgage. Mortgage money is the cheapest money you'll ever buy. Most people need to borrow money during their lives. So why pay 8, 12, 15, 18% on a credit card when you can borrow at rates of, less than 6%, 4, 3.9, 4, 5, 6%. Why would you do that? There's no yields in savings. So what happens is, I just got finished reading Why the Rich Get Richer. One of the secrets is that they don't use, money as debt. So you got to learn how to use debt, good debt, which means that you use other people's money to buy an asset that will cash flow. And so you want to use this cheap money and use positive leverage to your advantage. Here's the third reason to carry a big, long mortgage. If you're taking notes, this is reason number 3. Is the best way to lower your taxes. See, interest you pay on personal loans, auto loans, credit cards is not tax deductible. But for most people, the interest you pay on your mortgage is fully tax deductible, making it the cheapest loan you'll ever get, even cheaper, right? And so imagine borrowing money for a net cost of less than 5%, less than 4%, okay? That is, and you can do that with a mortgage loan and then carry it out for 3 years. I'll never forget this. I didn't even understand this till about 15 years after my dad told me this. And so in the 70s, we had a supermarket, so we're making pretty good money. So he bought our first house in Philly for $13,000 at 2% interest over 30 years. So he had a mortgage payment of like $112 a month, something crazy. And so when I was in high school, this is in the 70s. So now, mortgage rates were like 18%, money market account used to pay 18%, annuities, but your mortgages were 18%. So what happens is, because inflation was, this is with Jimmy Carter and the oil embargo, and Nixon took us off the gold standard. So inflation was rampant. So, and he would go, I said, well, Dad, the mortgage is $112. I started to get an idea of what was going on. I was like, maybe a junior, senior in high school. So, and I knew, and we had a supermarket, so he was making pretty good money. So he could have paid the house off. He goes, why would I pay the house off? I got 1963 money. And I didn't understand that statement till about 15 years later, maybe even 20, till I got into this stuff. I was like, okay, That was he was talking about. And he understood that then. So it is the best way to lower your tax. So if you are middle income and you right now, if you don't have a business, the only two tax advantages you really have are your mortgage interest and your children. Okay. And so you don't want to kill, one of the two few tax breaks that you have. All right. Reason number 4, you got to get cash out of the house. I'm not advocating you just pull cash out of the house, but people have this idea that if I pay extra on the mortgage, I've got this equity and it's like money in the bank. It's not, okay? See, the main reason people turn to borrowing is because they have little or no cash income. And so if you ever suffer a job loss, a major medical or other financial crisis, try to get a loan then, okay? You'll find yourself unable to get a home loan. That's because banks don't like to lend money if you're already in financial difficulty. That's why you should get, you always get debt or get a HELOC. You got to borrow money when you don't need it. Okay. A bank is like a friend that will loan you the umbrella when the sun is shining, but when it starts raining, they're going to take their umbrella back. Okay. And so you've got to get money when you don't need it. So if you lose your job, if you have a disaster, if you, some emergency and you've been paying extra. I asked the woman I was talking to, I said, listen, you've been seeing all this extra money. Your payment hasn't changed. So, you're wondering why your cash flow, why you don't have any money. I says, there's an order in which you do stuff. So you're paying extra money on the mortgage. You have no savings, but you're saving $200 a week. And then when you get the money, you give it all away. Okay. And you still have this mortgage payment because you're trying to get rid of the daggone mortgage. But I said, listen, here's when you can, you may even talk to me about paying extra on a mortgage. When you've got 6 months, 12 months of your bill money set aside. So if you're out of work, you could maintain your lifestyle, raise your kids, and eat for 12 months without breaking a sweat. Okay. And then we got you investing a little bit, you're earning some cash flow. Now, if you have so much money that you still don't know what to do with it, then pay the house off. So I know a person like that who's I interviewed him on the show. See, he's in that situation. Most people don't have extra money to do that kind of stuff. And see, so I would show you a better way where you can actually do that, have the liquidity. And then if you want to pay the house off, see, we teach people you can borrow against your life insurance, pay the house off, and then recapture your money. See, so, but at least while you're getting positive leverage, you're getting compound interest, you're getting tax-free growth, and you still have access to capital because life happens. Right now, where it's in the house, it's not liquid, okay? And it's risky, and you can lose control of that equity very quickly. So reason number 4, you need to be able to access the money when you can, okay? Now, reason number 5, the mortgage becomes cheaper over time. So this is the power of inflation. See, whatever mortgage you take out, say in 2017, and if you don't refinance, that payment is still the same 20 years from now. Now, it may fluctuate up and down with your insurance and your taxes. Your escrow may change, but the basic principal and interest is locked in. So then you've locked in, what is your interest rate now? 3.5%, 3.9%, 4%, right? You're locking in cheap money. But what happens to your income? See, the Fed and the government's trying to cause inflation. Well, the deflation makes the debt payback cheaper. Okay. So why would you take your more valuable today dollars and give them away when you can use those dollars to make you money and pay them back? I told you, look, pay them back with the same monopoly money they're giving you. Okay. And you stretch that payment out and you recirculate that money to make money for you. See, remember we talked about the 7 principles of prosperity. See, it's flow, control. See, if you're paying extra out on the house, you lack control. So you need to have liquidity, use, and control of your capital. So when you pay extra on a mortgage, is it liquid? No, unless you have a line of credit that you have to qualify for. Can you use it? No. Do you have control? No. Is it earning a rate of return? No. Okay. Why would you do that? All right. And so you have to think. So that is my little rant for this morning, talking about harnessing the power of your mortgage. In the show notes, I'm actually going to do a talk on this and go deeper on this because I'm getting a lot of questions around this. But just suffice it to say, folks, if it's good for the bank, it is definitely, definitely bad for you. Okay. So you have to think, the first tenet of prosperity economics movement is think from a prosperous mindset. And you have to do the numbers. So I invite you. So look in the show notes for us. There's a couple things. Look in the show notes for by the time this comes out, I will have recorded a video or either a webinar that you can link to and watch to this. I also do liability audits. So I will actually create a mortgage uh, plan for you, and we'll look at that. Should you buy or rent? Should you? What's the best way to restructure your debt? We actually do a debt snowball, or which is how to stack the debt up, or should you refinance? Should you refinance and consolidate debt? So there's numbers around that. One time I had a client they were going to. This is where all of this misinformation, because you get information from realtors or mortgage people. They're trying to sell you products, but you have to do your homework. Like I always tell my clients, it's your money. All right. So even this person, I said, listen, I'm going to show you how they work. So I'm going to show you a better way that maybe you can do with this money, but you're grown. So at the end of the day, if that's what you want to do, then God bless you. At least you know the truth now. So if you choose to do it that way, my conscience is clear because I showed you, all right, that wasn't the best thing to do. So other than that, I have no strong feelings in the matter, right? But I'll do analysis for you. Just send an email to kurtmay@gmail.com. In the show note, you can download the Financial Planning Has Failed, and you'll start to begin to think from a prosperous mindset and understand the prosperity economics movement, because this decision of how you're paying your mortgage is a big deal. Okay. And it is one of your biggest wealth transfers. I had somebody that they had sold a house. They wanted to put a big down payment. They were self-employed or they had a business going. And what they were worried about was, well, we're going to put this, they were going to put like some obscene number, like $50,000, $60,000 down. I was like, are you crazy? Okay. I said, well, hold it. Matter of fact, I was talking to the wife who I went to school with. He said, well, he wants to do it this way. I was like, what are you trying to accomplish? Well, we want to keep our expenses down just in case. So we're going to take part of this new money and roll it over and have a bigger down payment. So I'm trying to remember the exact numbers, but whatever you wanted to do, I said, well, listen, can you give them, it might have been like 25, 30%, some ridiculous amount of money, understanding that your money will never be worth more than it is now and equity has no rate of return. Why would you put that big down payment down? Because they wanted a lower payment. So it says, okay, what if you just put 10% down? Or I gave him a number. Said, how about this? And it saved him like $20,000, $25,000, $30,000, wherever it was, whatever I said was like $30,000 cheaper. I said, well, do you know what the difference in the payment would be if you only gave them this? You could still qualify for the house. Do you know the difference in the payment was like $125 a month? And so now, would you want to give up 30 grand so you can save $125, $104 a month mortgage payment? Or would that money be better off? Would you feel more secure if you had that $20, $25, $30,000 liquid in savings? If you're a business owner, if you're not a business owner, you're going to feel better. You sleep at night with that money. And see, so you've got to do the numbers to understand how this works. And so that is starting to think. That's why I tell you, you're your best financial planner. So stop getting dogma from, clips on TV and start figuring out how this stuff works. All right. And so that's the purpose of this podcast. So, because I get so many people that want to do that. And it's just, as I told the person, I said, listen, how would you feel? You're telling me you don't have any savings. So when your SUSU comes due and you get that money, first of all, I was going to go there, the fact that you're giving up this money, you're not making any money on it during the course of the whole time until your time comes around to get the money. But so you're losing opportunity costs. That's another concept. But now you get it, and the first thing you do is give it away. How much savings you got? Nothing. Well, why in the world would you give it away then? Okay. I said, listen, how would you feel if you did that, and let's say it was $5,000-$10,000, and you just let it sit in a money market account, how would you feel? Would you feel better? Would you feel more secure? Would your peace of mind grow? He said, yes, it would. I said, well, why don't you do that then? Okay. And let's build that up. And then, I want to get another house. All right. Well, you don't need to pay this house off to get the other house, And so it's just so much, especially sometimes if you're, from an immigrant situation, you don't understand about our property system, the banking system, because I know people with serious distrust of banks from where they come from. But, you've got to learn. See, it's hard to win a game if you don't know the rules. And a lot of times we either play by the wrong rules or we don't know the rules at all. And it's hard to win that game. That's like me trying to play you in chess. And either I don't know how to play or I'm using the rules of checkers trying to be the chess master. You're going to lose that game. And that's what we do out here when we're dealing with banks and insurance companies and Wall Street. We're playing a completely different game. Matter of fact, their game is built on you knowing enough about the money game to play the game, but not how to win. Okay. And so there are transfers built into you not knowing how to play. So they're getting rich off of you staying in the game a long time through fees, through charges, through just, Wall Street. They make money whether you make money or not, so there's all these things built in, and you've got to learn how to play the game and keep more of that money in your pocket. So guys, I went long, keep a lookout. So email me, look for the video associated with that. I'll put that in the show notes as my gift to you, but do your homework and remember to subscribe to the show if this is the first time you're hearing it, and share the show and go to iTunes, leave me a review. If you like it, feel free to email me at kurtmay@gmail.com. Let me know if you have any show topics. I'm trying to find somebody to talk to about, like Bitcoin, for example, that I'm hearing a lot of hype around that. Y'all have a prosperous day, and I look forward to talking to you soon.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted before syndication or rebroadcasting.